$250,000, that's a big bill. And I bet you a lot of people listen to this. It's like, if I got hit with a $250,000 bill, that wrecks my business. And this can often happen with a wrong classification, as it can wreck your business. But I would say this to your point, you can have some of your workers be 1099 contractors and some of them be W-2 employees. So it's not necessarily that every worker has to fall into one or the other classifications. There can be a mix there. And it sounds like in your situation, you probably had a really good mix. It's just that 10% that should have been W-2 employees, you just weren't doing. And so, that mix kind of burned you, that it affected all 100%.
Welcome back, everyone, to Sweat Success Podcast. And I am honored to have a guy that actually did my taxes several years ago for my gyms and my businesses. I finally was able to pull him on the show today. And we're going to go through some tax stuff. I mean, we're in tax season right now. So this is like critically important, especially for small businesses, because you're trying to get all that information, trying to understand what you need to be doing and how can you really manage this stuff. Today, I got on the show Mike Jesowshek. He's got his own podcast. He's been running for 7 years. It's called the Small Business Tax Saving Podcast. Okay, so if you're a small business, this makes a lot of sense. Go listen to that podcast. He's got Tax Elm software, which he launched, and that's really for small businesses where you can dive right in and know exactly what you need to be doing for your business. And then he just wrote a book called Small Business Tax Saving Handbook. So this guy is someone you want to listen to because he's not only run his own firm and sold a majority stake in that, but he started his own software company. He's got his podcast. He's been running for 7 years. He knows what he's talking about. So Mike, thanks for joining us on the show today, man.
Yeah, Michael, thanks for having me. Excited to kind of deep dive into this.
Yeah. So let's, just give a quick overview of, where you typically help small business owners. So we know what we're diving into.
Yeah. So, I started a cloud-based accounting firm back in 2013. Cloud-based, I always say cloud-based because now it's just common, but in 2013, it really wasn't. But started a cloud-based accounting firm back in 2013, just doing bookkeeping. And I was referring out a lot of tax work. I would have business owners come to me about tax stuff and would reach out to some of my referral contacts. And I always ran into this issue when asking any accountant about tax stuff is they'd always kind of like try to deflect it. So you ask, like, how do I hire my kids in my business? And they'd say, it depends. And I would just get frustrated with that because I would see business owners reach out, want to save taxes, want to do these strategies, but they hear that it depends or asking all these follow-up questions.
Yes and no. I always love the yes and no. I love those answers.
So they say, forget it. I'm just going to walk the other way. And they don't implement strategies. They don't do anything with that. And so as part of my practice, started to really deep dive into this tax planning thing and kind of fell in love with it and started a podcast with the sole intention of saying, I understand it depends. So don't get me wrong. Everybody's situation is different. You can't, copy and paste a strategy for everybody. But when I would start to do the research and look down to it, a tax strategy, 90% of a strategy was the same for everybody. And if we look at that concept of hiring your kids, what the strategy is, where it is in the law, what you need to do it right, and, what documentation you need to have on file, that's the same for everybody. Now, if you're a gym owner and I'm a plumber, how we hire our kids is going to look a little different. Or if you have an 8-year-old and I have a 20-year-old, how we hire our kids is going to look a little different. And that's the piece where it depends. And so really kind of set out on this passion to say, how do I get business owners 90% of the way there? So how do I get them that they say, okay, I understand about hiring my kids. I understand what I need to do right. I understand how I need to do it. Now I can just go to my accountant and say, okay, here's what I'm doing. Here's what I'm thinking. Can you help me with this a little bit? And my hope is that accountants would, instead of saying it depends, is saying, well, you're 90% of the way there. Let's dot our I's, cross the T's, and implement this tax strategy. And so that has really kind of been the passion with everything that we're doing nowadays and on the podcast side.
So I'm going to hit you with something because you got me thinking, because I got plenty of kids I can put to work. But one of the things is, is there an age limit? If I since this is a topic we're talking about right now, it wasn't one of the questions I intended on asking you, but thinking about it, if I were to hire my 12-year-old, can I do that? I have a 7-year-old. Can I hire my 7-year-old? Is that something that I can do where I also put back into like a 529 plan for them, right? How can I guess, massage the system, so to speak, so that way not only do they get benefit and they receive some kind of compensation, but also what they are doing is, also building a safety net for themselves or a nest egg for the future.
Yeah, absolutely. And that's like kind of exactly where we would go down is like, can you hire a 7-year-old? Yes. Can you hire your 12-year-old? Yes. And typically we say, once they hit about the age of 7 is when we can start to hire them. Now, the thing that we need to think about though is we got to do it right. Like your child, if you hire your child in your business, you do it right, you get a business expense and they pay no income taxes on that income. Great. And so what can we do? What can we do? Well, how much can we pay them to where they don't pay taxes on it? And the answer is up to the standard deduction. This year, 2025, that's $15,000. So some people will read around on the internet and say, okay, I'm just going to pay all my kids $15,000, max it out. They don't pay any income taxes on it. Well, is $15,000 for a 7-year-old make sense? Maybe, probably not, but maybe. A 15-year-old?
It does better than the lemonade stand.
Yeah, right. And so first off, it's like, okay, yeah, we need to do it right. But you're exactly right. If we're dotting our I's, crossing our T's, we're implementing that strategy correctly, where do I then like to kind of put that strategy on steroids? So we're already getting a business deduction. We're getting a business expense we're going to support our kids anyway. So now we're just getting a business deduction for supporting our kids. Great. Now, how do we put that on steroids? And you mentioned like a 529 plan. My favorite thing to do is to fund a Roth IRA. And so typically when they're not paying taxes on it, the downside of a Roth IRA, you put money into it, you don't get a tax deduction for it, but it grows tax-free and withdraws tax-free. But you don't get a deduction going in, and that's why everybody doesn't do them necessarily. But when you're not paying any taxes as your child, you don't need a deduction going in. So you're not paying taxes on the inside. You're growing tax-free and withdrawing tax-free. That's a win-win-win. And the other thing that I like about a Roth IRA is that you can access the principal dollars at any point, no penalties, no taxes, no nothing. So let's say over the course of 4 years, you put $5,000 each year into a Roth IRA. Now you have $20,000 in there. Let's say they go to college, that 20 turned into 30, whatever it might be. And now they're like, okay, I need some money. Well, they can pull that principal amount, that $20,000, that principal amount, they can pull out of that Roth IRA, no questions asked, no penalties, no taxes. So I kind of say it's a great, nest egg. You're starting a retirement account. If you do it right, they're going to retire with a really good nest egg of tax-free money. But worst case, if they do need those funds down the road for a house down payment, college, whatever it might be, they have that opportunity to do that. Now, I wouldn't encourage them to do it. I'd say if we can find a different method to fund those things, let's let that thing grow tax-free. But yeah, that's exactly an example of taking the strategy and concept of hiring your kids and kind of putting it on steroids a little bit, adding a little more oomph to it with just another strategy or another concept of a Roth IRA.
Do you still get the same benefits? For example, I have individuals, sometimes they ask me like, where do you put your money? And for me, it's, some ETFs. I dabble in some cryptocurrencies and NFTs, and then those are a little riskier, but then also S&P 500 index fund, just through Vanguard, right? Because you can self-manage it. But can you do that for your kids too? Can you go in and go, all right, well, I've got my 7 or 10-year-old, I'm going to throw some money into an S&P 500. It's going to auto deduct out of their paycheck. Is that something you can do? Because that's, it's been known that traditionally it's been running at about 10 or 11% over the past 100 years or so. Is that something that's possible, or you've got to kind of go into this Roth IRA kind of version so that way the money stays there for a while?
Yeah, you can do that. The problem is you run into what they call like a kiddie tax. So if there's enough earnings on those accounts from a non-qualified area, so let's just say you're doing a brokerage account, not a qualified or retirement account of any sort, and they're earning over a certain amount, now that those earnings could potentially be taxed at the parents' rate, your rate. And the whole idea was they don't want the parents putting money to their kids at a low income tax rate and then just getting that money back to them, and they pay taxes at a lower rate. But the Roth IRA can be a great tool for that. And I would even say, let's take that up a level with a Roth IRA is you can self-direct Roth IRAs as well. And so let's say you wanted to get into real estate and you're now, your kids are 25 years old and they want to get into real estate. You want to get into real estate. They could get into real estate having no cash, but they could invest their Roth IRA funds into a partnership that you own some, another kid owns some, and you're all putting Roth IRA money or real money, up to you, but that gives that opportunity where you could self-direct that Roth IRA too, and whenever you wanted. including crypto, whatever it is, you could self-direct those Roth IRA monies too. So yeah, just something, if you keep it into a non-qualified account, a brokerage account, something like that, then you do potentially run up to that kiddie tax issue.
Mm-hmm.
But, they would depend on the earnings and things like that.
What is the determining factor? What's qualified? What's not qualified?
So a non-qualified account would be something like a brokerage account where you just put in, or a savings account, or anything that's basically not inside of a retirement vehicle. So a qualified account would be like a retirement plan. If you had life insurance, something like that, that'd be something that's on the side. That's something that's not taxable to you today, but taxable to you down the road. Then it, would be avoided from that kiddie tax, as an example. If it was something like earnings inside of a Roth account are not taxable today. And they're not taxable ever, but even if it was taxable at some point, they wouldn't be taxable today until you have that withdrawals. And that's where you'd start to face that kind of kiddie tax issue.
Is there an age limit? So let's say now my 12-year-old, he's 18, right? Turns 18. And when that day comes, are all those advantages then wiped out, and now he's taxed differently?
Yeah. So, I think the age where the kiddie tax comes into play goes away. Should I say goes away? Is at the age of, I believe it's 24. But if they are going out on their own and not a dependent of yours at age 18 or whatever it might be, and don't quote me on this, but I believe at that age, then they would be kind of their own entity. But if they're going to college, they're still dependent of yours, everything else, they would still kind of fall within that realm until I believe it's the age of 24. And that's when it's kind of cut off at that point.
Okay. And they're at this point, they're W-2'd employees of your company. They're not contractors or anything, right?
Yeah. So, that's the question that we ask. Typically when they are 7 to 18, we would want them to be a W-2 employee. And the reason for that being is that, that if you're operating as a sole proprietorship, and you pay your kid out of a sole proprietorship, and we could talk about S corps and things like that right now, but if we're hiring our kids out of a sole proprietorship, they don't pay any income taxes on that because they're under the standard deduction, and they don't have to pay Social Security, Medicare, or federal unemployment because they're a direct dependent of yours, and you're paying them out of a sole proprietorship. So that's great. Now, if we paid them as a 1099 under the age of 18, then they would have self-employment tax on that. Now they'd be able to offset some of that income potentially, but it opens up a whole can of worms that we wouldn't want to open up. Now that kind of shifts once they hit the age of 18, because now they're not a direct dependent of ours per se under law. So they would have to be paying Social Security and Medicare if we kept them on as a W-2. And so once they hit age 18, we often talk about, okay, where can we shift this person into? And it depends on what type of work they're doing. When the whole independent contractor, and this comes down to whether it's your kids or not kids, is often a highly debated area. But I always say, even with your kids, if they look like an employee, act like an employee, everything seems like an employee, they're still got to be paid a W-2. Okay. But more often than not, it's your kids going off to college, and maybe they're doing some social media for some of your businesses, or maybe they're helping out a little bit in this area where it is truly more of like a contractor relationship, at least when they're going through college. Then I like to put them as a 1099. And the reason being is they can start to offset some of those expenses. We might pay them $10,000 throughout the year, but maybe they're only paying income taxes on $3,000 because we have $7,000 of expenses, and our kids traveling to go meet their client, which happens to be their parents. And, there's costs associated with that as well. So general rule of thumb, in a perfect world, 7 years old to 18, W-2 employee, 18 and older, 1099 contractor. But I say that with a grain of salt, is oftentimes, once they hit that 18, is independent contractor still might not be available if they're acting like an employee, looking like an employee, everything else.
So before we jump into the, S corps and C corps and, how all these things kind of wrap up and how you might want to utilize them. I was at a point, and I think maybe I shared this with you years ago, because you actually had to go back and redo some taxes for me. But I had gotten some initial advice. And anybody who's listened to some of my prior podcasts, they'll know that I had this tax liability. I got hammered by the IRS with $250,000 that I owed to them. And it was because I hired people, and when I hired them, they were all 1099 contractors. And that was the advice I was given based on the direction I was headed. It was an attorney that maybe that wasn't his area. His area was not employment law. It was, he's just putting agreements together for me. So maybe he didn't have the information he needed to advise me correctly. So I followed that. And then I got an accountant who also was my tax specialist, who did the bookkeeping, did the tax accounting, did my taxes, which personally, I'll get your opinion, but I always advise against. I always say, have a bookkeeper and then have your accountant and then have your tax person, have them all separate, because that way you get more eyes on what's going on with your numbers and somebody can hold somebody else accountable. But I got hammered on $250K, and it was all because I had 1099 contractors. Tell me what's the difference in how do you not put yourself in that position?
Yeah. And it's really hard because certain industries just have a trend. And I think health space specifically has that trend where the person down the street's doing 1099 contractors. Everyone I talk to at the conference is doing 1099 contractors. So that must be what's allowed there.
Right.
When the IRS looks at it, it really comes down to control. And oftentimes it's not even the IRS. Potentially it is the state agencies that are first attacking these. It depends on which state you're in and what's going on there. But what they're looking at when they attack these is they're looking at control. Who has control over that relationship? And I typically say this is pretty easy to tell if they're an independent contractor or a W-2 employee. So, who's determining what hours they're going to work? Who is determining their pay rates? Who is providing the equipment for them to do their work? And if all of that is the business owner, they tend to be, that business owner has control over them. They're saying, I need you to work at this time. Here's our going rate on what we pay. Here's the equipment. We'll buy all the equipment, everything you need to provide the service. All of that is screaming W-2 employee. Now, on the flip side, let's say I have a gym and we have a guy that comes in and he or she does various coaching within the gym, and they pay us $50 to rent out our space or whatever, rent out our space, and they come see different people there. And we don't have any control over them. They set their appointments with their clients. They maybe use our equipment, but they're controlling that relationship. Well, now we're talking about more of an independent contractor. And so it all comes down to control. Who is controlling the majority of that relationship? And that's going to tell you whether it's a W-2 employee or an independent contractor. And, when I see these happen, the majority of the time that someone gets caught in, and this likely I would assume is probably when they caught on to you, this is what the reason was, is you have a disgruntled employee that is angry about the situation. And this is what happens is they say, oh yeah, I'm going to go work for this company, 1099 contractor. They have no clue what that means. And so they say, yeah, they're getting their paycheck all throughout the year. All of a sudden, end of year hits, you send them a 1099. They go to file their taxes and they're like, you didn't pull any taxes out for me. And you're like, but no, you were an independent contractor. Yeah. I'm not supposed to pay taxes on that. And, oftentimes it's that first year is rough, but what really happens is when you have a bad relationship, they cut ties, then they report you to the state agency, they report you to the IRS, and that's when things start to come through.
So where it happened for me, it's been so many years, and so the clarity on it is not always there. You get older and things start to go. But if I remember correctly, what happened was we had someone who, I can't remember if they were sick or, maybe they weren't working with us anymore, and they went to file. What is it they file so that way they can get some compensation or some
unemployment
or something like that. So they went in and filed for that, and they couldn't get an unemployment.
Right.
And then the agency started looking into it, and then they came in. I remember them coming in to meet with me, and I'm like, who are these guys all dressed up in suits? This is a fitness community. So we sat down, and then they want to interview several of our team members. So they were interviewing several of our team members. Just so happened to be the few people that they picked were individuals that their primary job was working with us. Like they built their client base over the course of, a year or two, so much so that majority of their hours were with us at our gym. And like 90% of our other trainers and coaches, they had, other part-time jobs. So had they just picked different people, we probably would have been safe, but I don't know. It was the luck of the draw, and, my luck wasn't running for me that day.
Right. So I think it's just understanding and $250,000, that's a big that's a big bill. And I bet you a lot of people listen to this and say, like, if I got hit with a $250,000 bill, that wrecks my business. And this can often happen with a wrong classification, as it can wreck your business. But I would say this to your point, you can have some of your workers be 1099 contractors and some of them be W-2 employees. So it's not necessarily that every worker has to fall into one or the other classifications. There can be a mix there. And it sounds like in your situation, you probably had a really good mix. It's just that 10% that should have been W-2 employees, you just weren't doing. And so, that mix kind of burned you, that it affected all 100%. But
I wasn't planning for it, right? I mean, I had certain staff and we weren't paying attention specifically to who had more clients and who was growing at a faster clip. I mean, we knew some of them were doing well, but those that did well, they just stayed as a 1099. And of course they're happy because they're getting their full check. When they see their check, it's the whole thing, right? There's no taxes taken out. So we didn't think anything of it. And I was a novice entrepreneur at the time. So it really hit me hard. But the other thing too is it advantageous for the staff to be 1099s? Because they can, my perspective, I always believe people should set up their own businesses. It doesn't matter if you're working for a company, set up a business, because you can take some, advantages of having a business, even working for another company. What are the advantages of someone being a 1099? If they're a coach or a trainer or they're working for another company?
Yeah. So, me personally, when I talk to a lot of people, I would prefer to be a 1099 contractor than a W-2 employee, because it allows me to offset that income with expenses and different things that I have. And so this kind of goes into a concept that I think is super powerful for business owners to understand, is what I call maximizing deductions. And when I talk about maximizing deductions, so many people think, well, that means go out and buy a couple new pieces of equipment before the end of the year, go buy a new truck and those different things. And while if you do need those things, they can provide some really good tax breaks, but that's not what I'm talking about. When I tell business owners maximizing deductions, is I'm not going to be that accountant that says, oh, you have too much income, go buy a new truck that you don't really need, but just go buy a new truck. I look at maximizing deductions as, how do I look at the spending that I'm already doing, and how do I find a business purpose for it? And so it's this concept of after tax versus pre-tax spending. If you're a W-2 worker, you get your gross wages, all these taxes are taken out, and then you get your take-home pay. And any spending that you do with that take-home pay is what I call after-tax dollars. It's money that's already been taxed. But as a business owner, you have your sales or your revenue, and then all these expenses that go into it, and then you have your profit. And your profit is what you're taxed on. So any spending that you do within your business is considered pre-tax spending. It's spending that you're doing prior to those funds being taxed. And so my goal when I talk to business owners is to understand that concept. And then how do we shift that focus of saying, how do I get more spending in the business to move it from after-tax spending into pre-tax spending? And, we already talked about this concept of hiring your kids, but that's a prime example. We're supporting our kids all the time. Majority of people are doing it with after-tax dollars. They're paying for that basketball camp. They're sending them to amusement parks with their friends. They're using after-tax dollars for all those items. But if we can hire our kids and find a valid reason, valid job, and valid rate to pay our kids within our business, well, now we just took some after-tax spending and moved it to pre-tax spending and got a business expense for it. Or if you look at the home office or automobile or meals or travel, there's so many different areas of spending that is very easy to find a business purpose to move it from after-tax to pre-tax. And so when you go to that concept of saying, do I want to be a 1099 contractor or a W-2 employee? I'm picking 1099 contractor every day, because I can move some of my everyday spending that I would get no advantage from as a W-2 employee, but I can move it into a business expense, reduce that income, and thus overall pay less taxes.
Can you give an example of what that might be? So let's say your income for the year is $50,000 pre-tax, right? So your gross income is $50K. If you're a W-2, you probably are going to, off of that $50K, if you're W-2'd, what would you say? You're probably going to take home around 38, somewhere in there?
Yeah, say, the number I had in my head was 37.5. So yeah, right there.
So the difference, if you're 1099, you get paid $50K. And if I'm writing off my car, if I'm writing off any of my other expenses, even some apparel, or I'm in the fitness industry, so I have to take certain supplements in order to be prepped and ready for my customers. I know there's some limitations on those things, but I can write all those things off. What's the difference by percentage that I end up paying in tax on the two?
Yeah. So let's say that you had 50,000. So you're taking home 37,500 if you're a W-2 employee, as an example. If you are an independent contractor, you make $50,000. It all depends on what type of items we can get in there. But let's say we can turn your 50,000 into $20,000 in profit. Well, now we're paying taxes instead of paying 25% in taxes on 50,000, which is $12,500. We're only paying maybe $5,000 in taxes on that $20,000 of profit. Nothing changed. Your spending stays the same. It's just that home office, that automobile, those various different items that as a W-2 employee, you were just using after-tax dollars for. You got no tax benefit from that. Now, as a 1099 contractor, you are getting that tax benefit. But the one thing too, I would say is you also got to understand what you're getting yourself into, right? Because if you don't understand that you got to put something away for taxes, and you don't understand that you want to know this concept of moving after-tax spending into pre-tax spending, you're going to go file your return and you're going to put $50,000 of income on there, no expenses. And now you would have been better off a W-2 employee, right? Yeah. So you have to kind of understand what you're getting yourself into. And that goes back to that disgruntled employee. I always tell someone, when you have a 1099 contractor, you need to let them know what they're getting themselves into. Typically most people that are 1099 contractors know that situation, know what that means, and actually prefer it or ask for it or find a way to make that happen. But that's not always the case. And especially if you look back in the day and things have changed, people have been much more aware of this 1099 versus W-2, I would say, within the past 5-6 years. But beforehand, you would see fitness studios all the time doing the 1099 contractors. And then all of a sudden tax time hits and all these people are upset and they have these big tax bills. And now they're going backwards, where even those big tax bills back at that time, there still could have been things that they could have done to offset some of that income. But I always say tax planning happens between January and December. So if you're just hearing about this in March when you're filing your tax return, there's some things we can do, but the bulk of some of that planning you could have done is gone that year.
Yeah. So when I think about this, I'm an advocate for individuals who own their own business, to your point about certain things that are of value to your business, to be able to pay those things in full, right? So for example, I have a software company, BizOps, and we help gym owners grow their business through our software platform. And much like you have a tax service platform for software. Do you encourage those who are purchasing the software to pay in full because there's more advantage to have that as a write-off for the year versus, paying monthly on a subscription basis?
Yeah, I would say generally stating yes, but I also say let's not generalize that necessarily, because let's also look at your situation. You might be in a year that you had a low income year. Maybe you lost some big clients, but you have some big clients that are coming up next year, or you're doing these you're expecting some major increase of income because I'm working with Michael's software now, and my business is going to grow a lot next year. Maybe that full year subscription is going to make more sense in January than it will in December, because in January next year, I'm going to be in a 32% tax bracket. Right. This year I'm in 24. Would I rather have that big expense offset 32% or 24? I'd rather take it in the higher income year. Yeah. So yeah, I think in general, most of the times people are, having a high income year in the year that they're in, and they expect similar year next year and similar year after that. And so in general, I'd say, yeah, let's lower your income today as much as possible, unless they're in a situation where they think there's going to be a big tax bracket jump that could be affected, and utilize that more advantage that year. So, I had a client the other day. They bought a bunch of equipment. There was a big spending year for them. And so their income, they're usually, in the $300,000, $400,000 income range is typically their profit from their business. Even after maximizing deductions, utilizing all the strategies we talk about, they're still in that 400,000 range. But they had a big expense and equipment upgrade where they were paying $50,000 in profit this year. Significant change from what they're used to. For that person, I'm saying hold off on some of your spending until next year, because you don't need it this year. I don't want you to offset 10% in income this year when we know next year you're not going to have that big equipment expense, let's move some of that to next year. But I would say that's less likely than the other way around.
Let's go into business structure. We're talking about a lot of tax advantages that you can take on as a write-off or a deduction. When you look at S Corp, C Corps, LLCs, you have people who don't even create an LLC. They just use their social security number as their business for a 1099. What are the risks that people are taking if they are, I gave you a lot there, but what are the risks if someone's doing 1099, using their social security, not creating an LLC? And what are the disadvantages or advantages if you grow your business to a certain level, and when do you become an S Corp or a C Corp?
Yeah. So, when we talk about risks, from the high level, I can't really deep dive into this, but you have the LLCs, the C Corps, they're there from a legal standpoint for liability protection. That's one thing. And obviously I can't drill into that too deep, but if we just looked at a sole proprietorship, no LLC, no entity structure versus that same person in an LLC, from a tax standpoint, nothing changes out of the gate. Everything's taxed exactly the same. So there's no risk there from a tax standpoint per se. But what I always say is when you have an LLC, I recommend, to go back to your initial question, I recommend everybody have an LLC as soon as they start to be operational. Unless, with a caveat, if you're in a state like California where you're just getting started, you're going to have maybe 2 clients this year, make a couple $100, or you're driving Uber making, $2,000. Maybe it doesn't make sense. But if you are going to put an actual business in practice, having an LLC is what I recommend for the liability standpoint. But 2, one thing that we like to shift people to when it makes sense is an S corporation. And I don't know how many times I've seen someone that says, yeah, I don't have an LLC set up, just not big enough yet. And all of a sudden they have a great year. And they say, well, how about this S Corp thing? You talk about self-employment tax savings and how S Corps can help save on self-employment taxes. They say, I want to do that this year. And we say, well, let's look at what you have. And they don't have any LLC set up. I said, well, unfortunately, there is absolutely nothing that we can do from an S Corp standpoint because you don't have an entity structure set up. If you would have had an LLC set up, even if we're not S Corp status yet, if you would have had an LLC set up, then I can backdate it to whatever date we want to backdate that to. But you don't have the LLC set up, so we can't do that. And so many times people say, I'm getting in business, don't really know where it's going to go, but all of a sudden they get into it, they start taking off, they start doing well, and now they're kind of backtracking, saying, I want to do this S Corp, I want to learn about this S Corp, but they forgot that first step. You need to have an LLC set up. So my typical recommendation is, if this is going to be a real business, if this is just a toy hobby, you're not quite sure yet, maybe hold off, but wait till you see some revenue come in and then immediately get that LLC set up. It's not going to change anything from a tax perspective on day one. You're going to have the just annual LLC fee, which is pretty cheap in most states. But then it'll open up that, first off, give you legal protection, liability protection, which is great. But second off, it will open up that door for when the S Corp does make sense, we can go and backdate it. If you have a year where you're making $20,000 a year and all of a sudden you land a big client and you're up to 100 this year, well, that's in a situation where we'd want to go back and say, we probably want to look at potentially doing an S corporation. But if you don't have the LLC, it's not possible. So I recommend having an LLC for most people. Now, the other question to that is LLC or C Corp. And C Corps are something we don't typically recommend too often. There's certain instances where a C Corp can be helpful, especially, if you're getting outside investors and really kind of taking something off, C Corp can make sense. But more often than not, the LLC is the vehicle we want, and then doing an S Corp election when the time makes sense. Where we do see a C Corp potentially be an option is if we're doing an S Corp right away. So we're starting a company and then doing an S Corp election right away, then we can sometimes see that being done in a C Corporation. And there's some different planning instances where we would organize a C Corp for that, but it's not an every person and everyday thing that we see that with.
So how challenging is it for a small business owner to go from LLC, do their own taxes, and then go into S Corp? Because for me, when I switched over to an S Corp and I had, 3, 4, 5 different businesses under that, I saw immediate advantages. But at that point, like me knowing what was going on with the filing and how the taxes were created, I mean, there's money flowing from this company to that company. And up through this S Corp, and I didn't understand it. It was too much for me to, unless I just spent my time on that during the day, I'd probably learn it, but it was a lot. So, I mean, you've got a tax software. How does that help small businesses kind of get into that? And then also, at what stage do you consider doing an S Corp? Like, what is it, a revenue dollar value? Is it what is it?
Yeah. So typically when we're looking at a business owner, the sole reason that we would look at an S corporation is because someone's paying too much in self-employment taxes. So if you're set up as a single member LLC or no LLC and just a sole prop, you pay your normal income tax rate, whatever that is on the profit of your business. And then you pay self-employment taxes, roughly 15% on 100% of your income. And so as you can imagine, if you're making $100,000 a year, that's $15,000 in self-employment taxes plus your normal ordinary income tax rate. And so the S corporation helps shield that self-employment tax because we split your income into two pieces. You have a salary piece and then a distribution piece. And you're required to take a salary, a reasonable salary for the work you're doing as the owner, but let's say it's 50% or 40%. So if you were making 100,000, you're taking a salary of 40,000. You're paying self-employment taxes. It's not called that, but it's essentially the same thing on that 40,000, but you're erasing self-employment taxes on $60,000. So that's where that benefit comes in. And so the question of when does it make sense to go S Corp route? Typically we say around $50,000 or so in profit on an annual basis, and that's after all your expenses. So if your 1099 is 50, you're probably not quite an S Corp rep, because I would hope that 50 turns into 30, 20, whatever it might be before it is taxable. But we typically say once you have profit in your business of around 50,000, that's when the S Corp makes sense. And why 50,000? Because if we're saving self-employment taxes, wouldn't it make sense at $10,000? And the answer is yeah, you would have savings at that level.
But it's pretty insignificant.
And you kind of iterated to this, is that S Corps bring a little bit more complexity to the situation. The tax return's a little bit more complex. The tax return costs more to have someone prepare it, or if you're preparing it yourself, there's going to be a little bit more of a learning curve, and you have to run payroll to yourself. You have to pay yourself a reasonable salary, which no one should ever run payroll by hand. It should always be done through software. So you're talking $50 a month for a software subscription, and at lower income levels, at a 40,000, 30,000, 20,000, you're always going to be saving that self-employment taxes, but you're going to have some more compliance costs and payroll costs. So that really makes it a no-brainer once you start to hit around that $50,000 or so in income.
What does your tax software do? So, I mean, the listeners that are listening and they're going, okay, Mike, I do have to file my taxes, and I'm a small business owner. How can they get involved in your software? And when does it make the right sense for them to do that? Like who's the ideal person to use your software?
So our software, we're that strategist piece on the tax side. So we don't do tax prep and filing. We don't do bookkeeping. All we do is help people understand what strategies are available to them, what tax strategies and savings are available to them, and help them implement it. And, one thing that I constantly heard from business owners I was talking around is, one, I can never get a hold of my accountant. And, when I do get a hold of them, I don't really understand what they're saying. They don't really answer my questions. That was one thing. And then the other main complaint I heard is, my accountant doesn't help with tax planning. They don't bring anything to me. They don't help me. They don't, explore these items with me. And so that's really what we built Tax Helm for, is we have a full team of tax experts that they have unlimited access to. We help walk them through start to finish implementation of all the strategies. And so we look at it as we pair well. Most of our members have an accountant that they know, like, trust, love, and have used for many years, that just doesn't do tax planning with them. And that's very common. And there's nothing wrong with that. And we say, yeah, we want you to continue to use that person that you know, like, and trust for tax preparation. Let us be your tax strategist. And then the other kind of handful of people that come to us are people that prepare their own tax returns. And they want that strategy piece because obviously they're kind of doing everything on their own at that point. So we don't help with the filing per se, unless it's, a specific tax strategy. So
you get direction though. I mean, so they know what the heck they're doing.
If we look at an S corporation, that's a filing that needs to be done to elect S Corp status. We teach them how to do that themselves and everything they need to do, what boxes to fill out, everything from that standpoint, we help them along with.
Yeah, I see that, it's interesting because we're running parallel paths, you and I. I was in the gym industry. You were an accountant and you were preparing taxes. I got into software, and then you got into software. and you're coaching, and now I'm coaching other business owners, but similar to the same things that you hear from people who are talking taxes to you and the conversations they're having with their accountants, is that strategy, is that direction. I get the same thing, right? When I'm selling our software, our conversations get more deep than just here's the plans that you can implement into the software and here's how you roll this stuff out. It really evolves into the strategy of your business, right? And what are your end goals? How do you want to get there? What are you looking at? And that was, probably one of the things that drew me to you long ago, was the fact that you looked at things from a business lens and not just a pencil to paper, let's get your taxes filed and just submitted on time. You were really looking at how can we implement certain things that would safeguard you, reduce your liability on tax, and also put you in a position for the next year. And, anybody that's listening to this, listen to Mike's podcast. He's got some great stuff there. He's really got a lot of great material, as well as his book. And Mike, it's been a pleasure having you on the show. All the knowledge that you just unveiled, hopefully everybody gets a lot of value out of it. And we're going to have some material that you guys can download, some resources and tools that Mike has willingly shared. So that'll be available to you as well. Mike, where can they find you? I would be happy to tell them, but I know that so go ahead.
Yeah. Best place to find us is taxsavingspodcast.com. On there's links to TaxHelm, there's links to our book, our YouTube channel, everything else. And then you can find out TaxHelm at taxelm.com. And, Michael, one thing that I've always noticed and talked to business owners about is that so many people dive into podcasts, dive into trainings, and they learn all these different things. And that's great. Learning's great. But what I always tell people, especially when it comes to tax planning, is learning this stuff is one thing, but that doesn't save you anything. You could read 1,000 books on tax savings. That doesn't do anything. It's taking that action. So I always encourage people, when they listen to a podcast, they hear something that's enjoyable to them, I say, write it down, put something on your calendar so that in a month from now or 2 weeks from now, whenever it might be, you're revisiting that topic and actually putting it into practice, whatever you heard, whatever you discussed, so that you can actually get the results from that instead of just sitting here and learning. And I fall victim to this in the podcasts I listen to, but it's just kind of that constant reminder.
Yeah. Execution is key. You can listen to stuff all day long and absorb as much information as you want to. It's the same scenario. You got all these big coaches out there, even Tony Robbins, he's got a lot of people in his audience, and what percentage continues to come back to the same event that he, produced just the year before? That audience is in a position where they really haven't taken action yet. And the same thing goes for really anybody, to your point. You got to listen to the material, use it, and then execute on it. So thanks, Mike. I appreciate that.
Yeah. Thanks for having me.
Yeah. Loved it. Thank you so much. Everyone, thanks for listening to the show. Again, love having you guys here. Really appreciate you guys listening. If you like this, hit subscribe, smash those like buttons. And as always, sharing is caring. My kids always tell me that. And I'll see you guys on the flip side.